If you are a business owner and you are considering selling your business, estate tax considerations should be part of the selling process. Right now, each individual can give away, either during their life or at death, $11.7 million. So as a couple, that's $23.4 million that you can give away. Whatever the value of the assets are that are in your estate will count toward that $11.4 million. The idea is to reduce the value of your assets as much as possible. There are several things that you can do when you are anticipating selling your business to help minimize the value that's going to be in your estate and thus your estate tax. One of the most basic things to do is to make gifts during life using your annual exclusion amount. Everybody has the ability to give away $15,000 to any number of individuals, and that's both a husband and a wife have the ability to do that. The $15,000 can be given to anybody. It can be given to your children, grandchildren, strangers off the street, whatever you want to do. That will reduce your estate because you are taking $15,000 and you are getting it out of and you're giving it to someone else. It won't be included in your estate. So if you have a closely held business, you could give shares of stock to your family members at the rate of $15,000 per year. Now, that might not be a significant amount in any one year, but if you start doing that as part of your annual planning process well in advance of the sale of the business, then you have the ability to reduce your estate by a fairly significant amount. Another technique that is fairly common is known as a sale to an intentionally defective grantor trust. Now, a grantor trust is a certain type of trust that, for income tax purposes, is disregarded, meaning the grantor of the trust and the trust itself are the same for income tax purposes. But for estate tax purposes, the grantor trust is not considered the same as the grantor. The grantor trust is out of the estate of the grantor. So you could make transfers into a grantor trust, and for estate tax purposes, it would be out of your estate, but those transfers would be disregarded for income tax purposes. So in a sale to an intentionally defective grantor trust, the business owner is selling the business or part of the business to the grantor trust in exchange for a note. Now, that sale is disregarded for income tax purposes because it's a grantor trust. So if there's any gain on that transfer, it won't be recognized for income tax purposes. But for estate tax purposes, the stock that was transferred, the business, is out of the grantor's estate. Although the transfer is out of the grantor's estate for estate tax purposes, you want to minimize the value of that transfer because you want to preserve as much of your $11.4 million as possible. That's why the note is used. So there is an exchange of consideration. You're transferring your stock, but you're getting back a note of equal value. The note is repaid over time. So how does this reduce your estate? It reduces your estate by the appreciation in the assets that are held by the trust. So if you sell it to the trust for $100 and you take back a $100 note, and over 10 years that $100 note is paid off, the hope is that the value of the business has grown from $100 to $200, so that extra $100 in growth is not part of your estate. It's passed to your heirs. Another similar technique is what we call a grantor retained annuity trust. So again, we're using a grantor trust. And instead of doing a sale in exchange for a note, you are transferring the assets into the trust and you're taking back an annuity payment. And the annuity payment is structured so that it basically equals the value of the assets that are going into the trust. Again, the idea is that the value of the assets that are in the trust grow more than the interest rate that's being charged on the annuity payment. And the interest rate that's charged on the annuity payment is determined by IRS tables, and right now they're at pretty much historic lows. So as long as you can get a better return on the assets that are in the GRAT, then that's another method of getting the appreciation out of the estate. Another fairly common technique is FLPs, or family limited partnerships, family limited liability companies. And what you're doing there is you're structuring your entity, or you're creating an entity and putting assets into it. And you as the creator are taking back or retaining a small percentage of the company, but it might be all of the voting percentage. So if in a limited liability company, I may keep 10 units of the limited liability company and give 90 units away. And the 90 units are non-voting units. So the creator of the entity retains the voting control through the voting units, but the value of the company is spread out over the entire 100 units. So when the creator of the entity dies, the only thing that's in the estate is the small percentage of voting control. And when you're making the transfers of the non-voting units, you're often able to use discounts on those gifts or sales. Discounts for lack of marketability, discounts for lack of control. So when you're transferring those 90 units, you're actually doing that on a discounted basis. So that's another way to get value out of your estate when you're contemplating selling your business.